Well, hello, hello. Thank you so much for joining me today. Hopefully, you are here to learn about transforming retirement savings into real estate wealth. If not, you've hopped on the wrong presentation. But I see we've still got people streaming coming in here, but I want to respect your time. So we are going to jump right into it. So this is all about how you can take IRAs and 401ks and turn them into apartment complex ownership and grow that wealth within your retirement accounts a lot faster than you could if you're limiting yourself to stocks and bonds, mutual funds, and that sort of stuff. So hopefully that is why you chose to join us today. But like I said, we're going to jump right into it, even though I know we still have some folks joining us here. So little disclaimer, have to do this. So sorry, but I am not a CPA. I'm not a financial advisor. I am not an attorney. Those are all people you may wish to speak with before you choose to do anything like this. Tax strategists, all of those kinds of professionals. So I am just what's called a capital allocator. I'll explain a little bit more about what that is. But basically, this is things I have learned. These are things that I have learned through my years of investing. And I've made a lot of mistakes, and I'm hoping to save you guys from making some of those and just teach you some things I didn't know when I entered into this world. You do not have to take frantic notes. I can share these slides with you if you want. So if you want to text this number, just text IRA to this number, and I will send you the slides so you don't have to do that. I will have a question answer period at the end. So this is live, unless you're watching a recording and seeing this, of course. But if you're with me live, there will be a Q&A at the end. So as you think of questions, go ahead and jot them down so we can tackle those at the end. I don't really want to stop the presentation and take questions all along the way, because then we may not get through all the slides. So please jot them down, have pen and paper handy, and then be ready to put those in the comment section when we get to the end. So if you're watching this in full screen mode, you may not see where the comment section is. So just make sure you switch over when we get to the end there. And just get familiar with that. I will also put a link in the comments at one point along the slide. So make sure you see where the comments are on your streaming service if you're not familiar with StreamYard, which is what we're using right now. So again, I'm Maria Zondervan. I am currently in Orlando, Florida. So if there are any Floridians out there, hello, welcome. And so I am what's called a capital allocator. So basically what that means is I look for investments primarily for my own money to go into. So I have a business, I have a couple of businesses, and we take cash flow from that and we put it into real estate investments on the passive side primarily. And so I travel a lot to a lot of real estate events, and I meet all the big sponsors of these various deals. I get to know them. I get to hear what kind of projects they've got coming up. And then I choose where to put my money in. And then I invite others to invest alongside me. So that's kind of what I do. And when we pool all our funds together, then we can usually get higher tier returns for everybody involved. So instead of us all investing, 25, 50, 100,000, whatever you've got going on, and coming in at those bottom tier levels, we can pool our money together and come in at a higher tier. So that's kind of what I do, is I find good investments to do that. Let's see, what else? I have a personal real estate portfolio. So I know a lot about real estate because I've done this. I've been doing this for over 25 years. I have single family homes, I have apartment complexes, and then I also do a lot of passive investing. So those are ones I have that are just owned by me, no partners, no passive investing, just active investing on that side. And then I also get involved with syndications, which syndications are just when you pull a lot of money with a lot of other people to buy something bigger than you might be able to buy on your own. And I do that again with all of those various things: single family homes, multifamily, aka apartment complexes, and also some hotel deals. So I'm also a business owner, as I mentioned. My husband and I, we own 2 Massage Envy franchise locations here in Florida. One is in Orlando, one is in West Melbourne. And every quarter, we see how those businesses are doing, and we see how much cash flow we can pull out of those. And that's what I use to invest passively in real estate. And that's when I invite others to do the same. So I spend a quarter every year looking for the deals that I want to put money into. And then I do that basically rinse and repeat throughout the year. And in between, I'm traveling to real estate events and finding all the good possibilities out there. So I do invest in every property that I invite others to invest in. So I'm not just pushing out deals for somebody else's purpose. I offer direct investments as well as investments through funds. So funds is kind of what I was talking about, where we pull all our money to get to the higher tiers. So if there's an investment I want to get into that has these tiered entryways, where we get more if we invest more, as you know, if we write one big check, I will pull together a fund to do that so we can all write one big check together. Some investments don't offer those tiers. It's the same returns for everybody, no matter how much you invest. And then I don't bother with that. So that's more of what a direct investment is. I currently hold investments in 6 states and in Puerto Rico. So passive investing really allows you to diversify in where those properties are, because you have a management team there that's taking care of everything. You don't have to do it. So it's not important to me that it is right here next to me, that I can keep an eye on it that way. It's just important to me that I'm in a good market. I'm looking for those growing markets with growing populations, strong demand for the properties that I'm offering, right? And in the case of Puerto Rico, there's some incredible tax benefits over there that I'm not going to get into right now, but that's why I'm in Puerto Rico, for the tax benefits. And I'm also a busy mom. I've got 2 boys. My oldest has autism. And in the real estate world, you'll often hear, as you do in entrepreneur worlds and stuff, that you have to have a big why, because this is not easy work sometimes. And you have to keep that why in focus. And my son's is my big why. My husband, of course, too, but particularly my son with autism, because we don't know how well he's going to do financially long term. So building a lot of equity, a lot of net worth to be able to pass down to him to make sure he's forever taken care of and doesn't become a burden on my younger son is part of what makes me tick and why I do this. So if there are any other special needs parents out there, shout out. I hear you. So why invest in commercial real estate with your retirement accounts? There's a lot of things you can actually invest in with your retirement account. So if you're on this call, I'm assuming you have some sort of interest in real estate, but you may not understand the difference between residential real estate, commercial real estate, what your options are, and why this might be a good avenue for you. So that's what we're going to talk about here. So first of all, what is commercial real estate? So if we're talking about things where people live in, we're talking about things that have 5 or more units. So when you're talking about apartment complex, which we call multifamily, you're talking about 5 units and up. So if it's a single family home, a duplex, triplex, or quadplex, those are still considered residential real estate. And that's confusing because residential, an apartment complex, it's still residential. There's still people living there. So people get confused about that. But 5 units and up, you qualify for commercial loans, commercial products, commercial pricing, all sorts of different things there. And they're valued differently than residential properties are. But there are other things. There are things like self-storage facilities, very popular right now. As you see more people moving in with families, they often have to store a lot of things. So storage facilities are doing really well right now. Mobile home parks, RV parks, very popular because you just own the land. Usually you don't own the homes on them. So it's less tenant heavy. You're just maintaining the land. Retail centers, I don't know that I would invest in those right now, but there was a time when those were doing really well. Hotels can be good. COVID, they hurt them, but right now they're doing really well. There's medical offices. Those are very popular. Those are nice because they can be triple niche, meaning the tenant is taking care of all repairs. They're even paying the taxes and insurance on the place. They're often long-term leases. So you can't push the rent as much as you can in other places that have, say, a 12-month lease, because these places might have a 10-year lease or something like that. But it's very hands-off. You know exactly what you're getting into. So that can be very appealing. The appeal to storage facilities is also that they're month to month, right? So you can actually change the prices anytime you need to bring in more renters or to increase the income. Restaurants is another one. I don't do any kind of restaurant investing, but I know people who do, and some people really like that space. So these are all considered commercial real estate, and all of these are things that you could potentially invest in using your retirement account. So let's talk about some of the benefits of investing in these. So a lot of times there's very steady cash flow that can come from these things. So if you're picturing an apartment complex, those people are paying rent every month, right? So as those rents come in, then you take out all the expenses for property management, upkeep of the property, paying the mortgage, all that kind of stuff. And then what's left over is cash flow that gets distributed to all the owners. And if you're investing in these properties, you do become an actual owner in the property. So it goes on your net worth balance sheet. So there can be that steady cash flow. It's very appealing to folks. Now, that depends on what you invest in. If you're investing in ground up development, for example, there's no cash flow because there's nobody living there. A lot of times that's a play on we're just going to build it and then sell it, right? So then it's just a big check at the end, which can be fine in your retirement account if you're not retired yet and you're just building up the value of that account and you don't need the cash flow yet, right? So there's usually a low risk of high economic and physical vacancy, especially in the multifamily space. So compared to buying a single family home. Single family home usually has one tenant or one family. And if they move out, you go from 100% occupancy to zero. Same if they stop paying, right? If they're there, but they're not paying, you're not collecting anything, then your economic vacancy is up there, right? If you have a 100-unit apartment complex, the odds of everybody moving out at the same time and going from 100% to 0% is pretty slim, right? So there's always going to be some turnover, but overall it's usually less. And with some of these other products we talked about, like medical office buildings, often have these long-term leases, and there's a lot of economic consequences if they move out before that. So there's lower risk involved from that standpoint. Tax benefits. Depending on the type of retirement account you use, whether it's IRA, 401k, traditional, or Roth, and we'll talk about what all those things are, investors can either enjoy tax-deferred or tax-free growth of their investments. This allows the investments to compound over time without immediate tax liabilities. So that can be very, very nice. It's completely passive. And the idea of being retired is that you're not out there flipping houses or doing something crazy like that, right? So that can be very attractive. The return on investment is generally much higher than in your smaller types of properties because of economies of scale. So just think about it. You've got a single family home. Let's say you're doing single family home rentals and the refrigerator goes out. You got to go buy a new refrigerator. Well, you're probably going to go to Home Depot or Lowe's or someplace like that and buy a refrigerator at retail price. If you are renovating an apartment complex and you need 100 new refrigerators, you're going to get that at wholesale, right? You're going to get it maybe shipped directly from the manufacturer, and you're going to get much lower price. Same with anything you need. You need a new roof, your price per square foot is going to be way less. Everything is just less when you talk about that kind of scale. And you usually get better vendors, usually get more reliable contractors because you're just working and operating at a higher scale. There's going to be a lot of competition for those type of jobs. So that is really nice. Less susceptible to market volatilities than stocks. If you're in the stock market right now, you've probably seen the roller coaster, right? And we are in an election cycle right now, which means it's going to be even more volatile than normal. So if you don't like volatility, it can be nice to diversify some of what you're invested in by putting some real estate in there because it's a lot more stable. Inflation hedge. So this is something we've just gone through a very fast inflationary period, and that cost a lot of people a lot of money in the different areas. Different investments took a hit, but real estate has done crazy things during the same inflationary period. If you've been out trying to buy a house, you probably know the prices have gone through the roof. And I actually feel really bad for new people coming in to the home buying market because it's very hard to get a new place right now. But in inflation, the price of everything goes up, right? And that, of course, includes real estate. It also includes rents. So it is more costly to rent a place now. And that's because taxes go up, insurance goes up, everything goes up, right? But when in commercial real estate, the properties are valued based on the income it is producing, not on comps, like with single family house, where, the value of your neighbor's house to the right and left of you is going to impact the value of your house. That's not how commercial real estate works. It's all based on the income that property generates. So as rents go up, the value of the property goes up substantially. And I'll show you a little example of that a little bit later. So it's a great hedge against inflation because as those rents are going up and the price of everything is going up, so is the value of these properties, and disproportionately so. Diversification, talked about that. As the stock market's doing its roller coaster, it might just be really nice to be able to diversify into something else. You can also diversify within real estate. We talked about all the different types of asset classes that you could get into, from mobile home parks to to apartment complexes, retail, whatever you like. So there's lots of ways to diversify here, and you do not need to know everything there is to know about running a self-storage place or mobile home park or apartment complex, because you're investing passively. Somebody else is going to be doing all the hard work on that side. So lots of diversification, and you can also diversify into different markets. You don't have to buy things just around where you are. So minimal management hassle, again, being a passive, and very scalable, because again, you don't have to add to your workload because somebody else is doing most of the work, right? So you can scale faster. If you're adding single family homes to your own rental portfolio, for example, there's only so much you can take on, right? You have to go find them, you have to negotiate the deals, you have to get them under contract, you have to manage them, you have to find tenants, you have to deal with those tenants, right? Every house that you add to your portfolio that way is going to be more workload on you. And the idea is we're preparing for retirement, we're already in retirement, and we don't want to add to the workload. So because it is passive, it is way more scalable. Um, yeah, because it doesn't add to your workload. Long-term appreciation, we all know this. You look at what houses were worth, 10 years ago, 15 years ago, 20 years ago. You can only imagine what they'll be worth in the future. So we get that long-term appreciation. And then there's something called forced appreciation. We're going to talk about this more on the next slide, but basically what this is it is ways to add value to the property that brings up your rental income, produces new income, or reduces expenses. And there's a lot of different ways that you can do that. But when you do that, you force the appreciation on the property. It increases in value faster. So, for example, you could buy an apartment complex, and let's say they weren't allowing pets, and now you're going to allow pets. So you're going to charge a pet fee when they move in, maybe a pet deposit, and maybe pet rent, right? So those are all new income streams for that property. Maybe the property didn't have washer dryers. You add washer dryers and you charge $50 more a month for having a washer dryer in your unit. And you might even sell them the washer dryers or rent it to them. So there's new income. Maybe you offered covered parking. Valet trash is very popular right now. Believe it or not, people are too lazy to take their trash to the garbage can, and you can charge to have someone come pick it up at their doorstep and do that for them. People will pay for that. And then there's lots of ways to reduce costs at an apartment complex. Maybe the contracts for lawn care had not been, or landscape in general, had not been renegotiated in 10 years. You can go in and put it back out for bid and see if you can get the price down. You might be able to find better property management. You might be able to lessen how long your turns take that reduce your expenses. Maybe they don't have LED lighting, and you can put that in and reduce the cost of electricity in all your common areas. Same with water savings. You could add solar power. There's all sorts of things you do. But anytime you change the equation of how much money that the net operating income is ultimately what we're talking about here, that's going to improve the value of the property upon sale, because it's all income driven. So let's take a look at an example here. So again, the value is based on finances, not on the appraisal. So when you increase that value by increasing revenue or decreasing expenses, here's what happens. So here's the equation. The value equals the net operating income divided by the cap rate. So cap rate for a particular area is pretty set. You can talk to a local broker in the area and they'll tell you what the cap rate of that area is. But essentially, the lower the cap rate, the more expensive the area is, the more expensive it is to buy property there. And the higher it is, the less expensive it is. And usually there's a teeter-totter effect here, right? One's going to cash flow more if it's less expensive to buy it, but the value at the end when you resell is less than something that you buy at a lower cap rate. It's more expensive, going to have less cash flow, but you're probably going to have a higher resale value. So it's a balancing act depending on the market you're in. But for this example, we're going to assume a 6% cap rate. All right. So here we're going to say we managed to increase the overall income by $50 a month. That's not very much. So we went through lots of examples of how you can do that, right? So just adding washer and dryers could be enough to get that $50 a month rental income. let's say it's a 100-unit apartment complex. So we're going to take that times 100, and then there's 12 months in a year. So we're going to multiply it times 12, and then we divide it by 6%. And that is $1 million increase in the value of that property, just like that. So that is what we talk about when we talk about forced appreciation. So you can imagine what happens if you buy an old, rundown, dilapidated apartment complex and you completely renovate it. Yes, of course, you're putting money in there, but you might be able to double your rents, right? So we see that happening a lot. A lot of these new, older properties are being turned around, and they're improving neighborhoods and making things more beautiful and giving people a nicer place to live. But yeah, it comes at a cost. Those rents go up, but the increased proportional value for the price of that property goes sky high when that happens. So that's why we see that happening a lot. So that's called forced depreciation, and that's something you can get with these larger apartment complexes. All right. So how can you use your retirement accounts to purchase real estate? Most people, a lot of people, including myself, did not know that this was even possible. So the key is to have what's called a self-directed account. So this means you are in charge of your retirement account. So a self-directed retirement account, such as a self-directed IRA called a SDIRA, or a self-directed 401k, allows investors to diversify their portfolios, including a wide range of investments, far more so than your traditional IRAs and 401ks, right? So this can include real estate. It can include private equity, precious metals. You want to go buy gold bars, put them under your mattress, you can do that. Cryptocurrency even, and lots of alternative investments. But the biggest use for it right now is real estate. A lot of people are using it for that. But you can just use it to really diversify your account. All right. So let's talk about some rules. There comes rules with these things. There are some things you cannot do. For one thing, you cannot engage in what's called self-dealing. So this is investing in assets that benefit you or other disqualified persons, primarily family members. So I can't go invest in my son's business, for example, okay? Or buy him a property or something like that. That's considered self-dealing. Personal use. Let's say, okay, I tell my custodian of my self-directed account that I want to go buy this property to make it into a short-term rental. And I do. I legitimately do. But I also go stay there myself during the summers because it's a really nice place. Cannot do that. You cannot live in something that you purchased as a investment property in your retirement account. So that's prohibited. There are certain things that are disqualified. Collectibles. You cannot do collectibles. And yes, alcoholic beverages can be considered a collectible. So that's people who have like fancy wine collections or something like that. That is not something you can do within a self-directed account. And you cannot buy life insurance policies. But other than that, there's a lot of things that you can buy with your self-directed account that's considered a qualified investment. There are some compliance and reporting things that you need to adhere to. And the biggest one really is that you need a custodian. So this is like a third-party intermediary between you and the IRS. And you want this person. They make sure that what you're investing in is legit and that you follow all the rules and report to the IRS on everything you need to. So that is kind of the step one in this, is finding a custodian to take care of these self-directed accounts. So and they're everywhere. You can literally just Google custodian for retirement accounts, and you can find all the ones in your area. If anybody out there needs some suggestions, I can always help you with some suggestions as well. But they're not uncommon, and you can find them everywhere. But look at their ratings. Yeah, we'll get into all that kind of stuff. There are some contribution limits, just like there are with your regular 401k and IRAs. So you do have to adhere to those. And you do still have to do the minimum required distributions once you reach the age of 72. Those rules don't change because it's self-directed. However, I will say there are ways around some of that. If you are in say you have a Roth 401k and you get to age 72 and you don't want to start taking those distributions, you can actually roll it into a Roth IRA, and there you don't have that requirement, if I have that correct. But talk to your CPA on that one. Make sure we got that right. So active management and involvement. This is another place. While you can Actively manage your self-directed retirement account by making the investment decisions and directing your custodian on what to do on your behalf. So they will execute all the transactions. So if you say, I want to invest in this property, they will do that on your behalf, right? But there are limitations to your day-to-day involvement in the operations of that asset. So in the real estate world, you cannot personally manage a rental property owned by your self-directed IRA. This means you can't perform repairs, collect rents, or handle tenant issues, okay? You have to have a third-party property management company if you're going to do that. So you could go buy your own property instead of going into syndication, but you would have to have a property management person. And if it's as simple as, oh, you just need a little touch-up paint in the kitchen, just this little wall, yep, you still have to hire a painter or have the property manager go do that. You cannot do it yourself. So that is one limitation. Business operations. You cannot run a business that you purchase through your self-directed IRA. So again, this is all about retirement, right? So you can't do something like that, but you can passively invest in somebody else's business. So you can buy shares in a company. That's kind of the same thing as buying stocks, right? So you can do that as long as you're not actively participating in it. And again, no self-dealing and no doing this with family members, right? You can't invest in your child or your grandparents' business or something like that. Improvements to properties, all the costs related to that have to be paid out from the funds within the self-directed account. So you can't pull funds from other places to compensate that. Everything has to be within that because ultimately your retirement account is what owns those properties. So as the owner, they need to be paying for that. Okay. And then you own the retirement account. So I've talked a lot about passive investing, but if you're not familiar, we're just going to look real quick at what passive investing really means. You know what? I just realized I had the slides kind of small on the screen here. Hopefully that's better. Sorry, should have done that earlier. So let's take a look at what passive investing is. So to understand that, let's first say what is active. Active investing is when you acquire something on your own, right? And you have to have the funds to do that, get the loans if you need loans or whatever. You have to manage any renovations involved with that. You have to manage leasing and managing the tenants and the residence itself. And it's going to be, you're going to be limited by your time, your knowledge, and the resources at your disposal. So this is what we see commonly in the single family home space. Versus passive, the deals are presented to you. It could be presented by a capital allocator like myself. I could say, hey, I've got this property that I'm investing in. Do you want to invest with me? Or it can be a deal sponsor. The actual person that's buying that property might be looking for investors and they might be advertising that online or at an event that you're at. So the deals are presented to you. You don't have to go look at them. They already have them under contract. Those same people, the deal sponsors, will manage all the renovations and they will manage the leasing agents and the tenants and all of that, handle all the repairs. And it gives you the ability to partner on much larger deals and scale much faster. Real estate space. So what do you need to do to be a passive investor? So first of all, you have to pick the asset class that you like. We talked about all the various possibilities there, right? Secondly, you have to define what your goals are. Are you interested in cash flow or equity? And I say or, but there are, of course, properties where you get both, but it's going to probably depend on where you are in your life right now. Because if this is money within your retirement account, right? So you can't tap into it until you pass a certain retirement age. Okay. So we talked about age 72 is when there might be some required distributions, but I think you're eligible. Now, I don't think, I know you're eligible to pull that money in your 50s, right? So depending on your account, the rules might be a little different, but I think it's 55 and a half or 59 and a half for most accounts. But prior to that, you may be younger than that right now, or you might be in that stage, or you may just not want cash flow right now. So if you're in your 40s or 50s, maybe you want to concentrate on equity because that is the overall wealth builder. That's the overall growth in the value of your property down the line, right? So when they sell, And you're not worried about the cash flow right now because you're not eligible to take it anyway. I mean, the cash flow, of course, would go back into your retirement account and it's there sitting for you, waiting for you, and it can be reinvested into other things. So it's not a bad thing to have the cash flow, but you might want to concentrate more on equity growth built versus if you're already retired, you now need that money to live on. You might want to look at deals that produce more cash flow because now you want to go party. You want to go travel the world, whatever it is. So you want lots of cash flow. You may have to give up some equity to get more cash flow. So there are different deals that are going to specialize in one or the other. When it comes to apartment complexes, they usually bring a little bit of both, unless you're looking at new construction where you're building something from the ground up, whether that is a retail shopping center, a hotel, self-storage, whatever it is. You can certainly get into them as new construction, and then there's nobody living there, so there's no cash flow. Others are a little mix. If you're buying into something that needs heavy renovations, there may not be any cash flow for the first year or even 2 years while they're putting money into the property, building it up so that they can eventually get much higher rents, have much better tenants there, right? And then you get a lot of cash flow and a ton of equity in the end because it's going to be worth a whole lot more than what they paid for it. So have liquidity to invest is a requirement if you're going to be able to invest passively. So your retirement account will probably need somewhere between $50,000 and $100,000 in it to get into most of these deals. There are deals where the minimum investment is $250,000. I've even seen $500,000. I've also seen ones where it's $25,000. So it can vary, but the vast majority are in the $50,000 to $100,000 range. You will need to find an operating partner. We talked about this. So the deal sponsor or a capital allocator that can help you find the deals. And you'll need to be either sophisticated or an accredited investor. So we'll spend a little time talking about this. So in order to invest in these deals, you need to know the basics at least of what you're doing. And anybody who is a reputable deal sponsor or a capital allocator is going to want to vet you to make sure you understand what you're investing in. Because nobody wants to have someone come back to them later and say, hey, I didn't know I won't be able to access my money for 5 years, for example. So say you bought something that had a hold plan of 5 years. So you need to prove that you know a little bit about what you're doing, right? So there's lots of free resources to get this education. There's YouTube channels, there's books, there's podcasts. The information is everywhere. I've got a ton of it on my website, right? So once you get that basic knowledge, that makes you into a sophisticated investor. And that now makes you eligible to invest in a lot of these deals. Some will be and also to be a sophisticated investor, you need to have a personal relationship with somebody that's offering the deal, be it a capital allocator or the deal sponsor directly. You need to know them for them to invite you into their deals. Now you can take it a step further and be an accredited investor. So an accredited investor also needs to have that knowledge, but they also meet certain wealth criteria, either by their net worth being $1 million or more, excluding the value of their home, right? So this is the value of your retirement account, any rental properties you may have, life insurance policies, collections, cars, boats, RVs, whatever it is. If you put all the value of everything you own together, and that's $1 million or more, you qualify as an accredited investor. The other way you can qualify for is by how much you make every year. If you make $200,000 or more, or $300,000 if you combine it with a spouse or more, you can be an accredited investor. So if you get into that category, you're now eligible to invest in what are called 506c properties or investment opportunities. And those could be deals that are advertised. You wouldn't necessarily need to know the deal sponsor to get into those deals. So those, they're just two different ways of getting into the deals. But there are deals available for both varieties, whether you're accredited or not. But you do need to be sophisticated. You do need to have some understanding of what you're investing in, which is always a good idea, honestly. And you need to learn to analyze deals. I'm not saying you need to sit there with the spreadsheets and go over every little income and expense and understand all the nitty-gritty details, but you need to be able to look at a proposal and a business plan. They're often called operating memorandums or pitch decks, or it's the information that is presented to you for you to analyze to see if this is a deal you want to get into. So you just need to have the basics of understanding this and know the key things to look for. Like I really focus on who the operators are, what their track record is, and the market of where that property is. Those are more important to me than the asset itself. But then you want to look at the asset itself and you want to look at the business plan overall, right? So you need to just learn some basics. And again, podcasts, YouTubes, books, tons of information out there on how to do that. All right, so that's kind of the basics of what you need to do as a passive investor. So you don't need to know how to manage tenants or any of that kind of stuff. So what are some of the types of investments you could get into? There are obviously different risks and rewards for getting into these various things. So multifamily, that we're just going to talk about. I'm going to focus in on the two most common ones. Again, there's lots of things. These are just kind of my favorites. But multifamily, the apartment complexes that we've been talking about. So there are some risks to those, right? Economic downturns can impact your residents, right? If they lose their job, they may not be able to pay rents. It can be a very competitive space in certain markets. They're overbuilding even, so you have to watch out for that kind of stuff. And there can be property management challenges. No, there are always property management challenges. The good thing is you don't have to deal with it, but you have to make sure that the person you're investing with is well equipped to deal with it, right? There are lots of rewards too. Potential cash flow. We talked about that. Depends on how it's structured. Economies of scale, the appreciation. Right now, demand for apartment complexes is probably higher than it has ever been. But overall, apartment complexes have always been demand because people always need a place to live. But right now, with it being so expensive to get into single family homes, it's more so. And then depreciation. So we haven't really talked about depreciation, but basically, this is a write off for well, anything can be depreciated in business, right? And real estate is no difference. The difference is that it's a paper loss. It's not a real loss that you can take off your taxes. But this does not apply when you are investing in your retirement accounts because you're already tax deferred or you are tax free. You have tax free growth or tax deferred, and we'll get into that a little bit more as we progress. So you can't really take advantage of the depreciation there. But if you were to invest outside of your retirement account, which a lot of my investors, they do both, right? So then you get this depreciation, which is it can be a huge tax savings for the income that you're making every month or so from these complexes. You won't have to necessarily pay the taxes on that. Okay. Another one that I really like is private lending. So a lot of people don't realize they can do this with their retirement accounts, but you can, and there are multiple different ways you can do this. So I will rent to people who are fixing and flipping properties. They need short-term loans, 6 to 9 months, somewhere in there, and they're willing to pay a pretty high interest rate for those short-term loans. But there are some risks to doing that, right? They could end up foreclosing on it if they don't pay you, but then you do own the property, so that's not terrible. There is no upside, meaning there's no equity component in the end. You're just getting a straight interest rate, and there are no tax benefits there. It's just income, right? But you can certainly loan out of your retirement account and get that stable cash flow. You can get compound interest, and you have liquidity there a little bit too, which you may not have as much in an apartment complex. You invest in an apartment complex, your money is tied to that complex until it sells. That might be 3 years, 5 years, 7 years, depends on what the business plan is, versus these are short-term loans, 6 to 9 months is pretty average. And there's a couple different ways you can do this. You can do it directly. If you know people who are fixing and flipping properties, you can lend to them directly and have an attorney set up that paperwork. It's not very difficult. Or you can find somebody who helps broker those kind of loans. Okay, so there are lots of people that help broker those. So they find person A and match them with person B, and they do the loan together, and they take a brokerage fee in the middle. Or there are private lending funds. So Blue Vikings Capital, my firm, we have a fund where you can invest in the fund, and the fund lends out the money, and they deal with any issues that may come up, right? And then we simply pay our investors out a straight percentage on that money. So they get monthly payments on that, 7 to 10% on what they put in the fund, depending on how much they invested originally, right? So there's different tiers and brackets there, but it's very simple. And then you don't have to deal with the finding a new property to invest in every time a loan ends. So those are some different options there in the private lending world. That is just a nice way to get high interest on it without locking up the money, if locking up the money is an issue. So two favorite strategies. Let's look at the typical structure of a passive real estate investment for those of you interested in that. So you usually have operating partners and you have your passive partners. So the operating partners, these are the deal sponsors. They're also called general partners, GPs. They might be called syndicators, lots of different names for it, but it all means the same thing. So they are the person that goes out and finds this property and they get it under contract. And when they do that, they form a new LLC. And that LLC will be owned by them and by the passive investors. So you do become a true owner, like I said, in these properties, right? So the general partners, they're responsible for finding that property, analyzing the opportunity and presenting that to the investors. They contribute capital to close that property. They usually put down the earnest money. They usually put down the cost for surveys, the environmental impact fees, all that kind of stuff. And then they contribute their expertise to the management of the property. And they are compensated by getting usually asset management fees on a monthly basis, which aren't usually very high. They're usually around 2 to 3%. And then mainly they get equity at the sale. So their entire job and how well they do hinges on how well they can force up the value of this property. So that benefits the passive investors because they don't have control over any of those things, right? So they are just putting in investment capital into this. That's their entire job, really. And then they're reviewing their monthly or quarterly statements that they get in, and they're receiving that cash flow, and then they get equity at the sale. So, but the biggest partner in this whole deal really is the banks. That's the beautiful thing about real estate is banks love it. They feel it's a pretty safe asset. So they're usually going to be willing to come in with anywhere from 65 to 80% of the capital needed to buy whatever this building or property is. So they're the biggest partner in all of this. And then like I said, the general partners, they're going to put in money to handle certain things. And then the passive investors, they're filling the gap between what the bank brings and the purchase price, or the purchase price plus any renovations, if there's renovations that need to be done. So that's where the passive investors get in. And as a reward, they become part owners and they get to partake in all that cash flow and equity. So that's kind of the typical structure of it all. Here are some examples of some passive investment opportunities that I offered to members of my Blue Vikings investment club. So these are 3 properties we did, and you can see that they range in size from approximately 100 units to upwards of 300 units. So, but they're all similar in that they're all apartment complexes in this case. They're all in markets that are growing fast. So Columbus, Ohio is really taking off right now. Humble, Texas, if you don't know where that is, it's in Houston, basically. Houston's taken off, right? Jacksonville, Florida is exploding right now. So they're growing markets where there's a high demand for this product. I also tend not to buy things that are brand new. So these are nice looking properties, but they're not brand new. So they have a value add component, right? There's some way to increase it and make them look brand new again. So for example, the Traditions at Slate Ridge, I believe it was built between 79 and 81, but it still looks great on the outside. But some of the units inside still look like you were stuck in that era. So they went in and renovated all of those to modern day standards. And now it looks like a brand new apartment complex, pretty much. They renovated the gym, they redid the pool area, the deck area, all that kind of stuff. So there's a lot of value add components there. And same with these other properties. They all had different ways to add value to them. There are people that buy into brand new apartment complexes. Basically, you're just doing that for cash flow when you do that, right? Because you're not going to be able to add any value to them. They're already really valuable. You bought them brand new. I also don't like real slummy properties. Just it's just not what I want to own. There's a lot of risk that can be involved with those. A lot of challenges. You got to make sure your property managers really understand how to deal with that kind of class of tenants. So I'd like to be somewhere in the middle. It's also nice because if the market changes and let's say a lot of people are losing their jobs, people in those brand new apartment complexes may not be able to afford to live there anymore. So they might drop down a level and end up in my apartment complex. Or if the market's going the other way and people are earning more and more income, people who are maybe in a lesser quality apartment complex can move up to this level. So I'm kind of I like being kind of right there in the middle. So that's just me personally. What kind of returns can these types of properties do? So we'll just take the Portofino as an example. So the cash flow on this, when looked over, so this was a 5-year hold period. So when you look at the cash flow over that 5 years and you divide it out, it comes to about 8.3% per year on your investment. Now, that doesn't mean you get 8.3% every year. At the beginning, when you have all those closing costs and renovation costs, it's less. And then towards the end, it's very high. But on average, this is where you end up. And that is not including the money you get at the sale of the property. That's where you get the AAR, the average annualized return. So that looks at all your returns. So it takes the cash flow plus the proceeds at sale. And if you were to average all of that out, that gets you at 26%. So you can see this is making really good returns on your money, right? But you're not seeing that every year. You're seeing that towards the end. So this is primarily an equity play here, not so much on the cash flow side. Your IRR is basically the same thing as your average annualized return, but it takes into account the time value of money. So if I give you $1 today and you immediately give me back $2, I'm pretty happy. I made 100% increase in the value of my investment instantly, right? But if I give you $1 today and you give me back $2 10 years from now, I'm less excited, right? It took me 10 years to double that dollar. So that is what IRR does. It takes into account the time value of money. It looks at when you get your money back in various things. So on this one, it's at 20%, which is very good. And then the equity multiple is basically just looking at your overall return of your money. So for every dollar you put into this, you anticipate getting $2.30 back. That's what 2.3x multiple means. So that's just an overall. And again, how long the hold time there equates to whether or not that's a good deal. If that takes you 2 years, that's amazing. If it takes you 20 years, that's only so-so, right? The minimum investment on this particular one was $50,000. And the maximum investment was $2 million. So that kind of gives you the range of where you can invest in. And this particular one was a 5-year hold. So that give you kind of a look at what those are. So if passive investing interests you, then these are the steps to setting up a self-directed retirement account. So we talked about the need for a custodian. So that's the first thing. You need to select one of those. And when you're selecting those, there's a couple of things to consider. There are fees and costs associated with them. Some of them will have different layers that you can, or packages that you can choose from. Depends on how much investing in and out you're going to do, how much money you have in that account, that sort of stuff. But you should pay attention to those fees and costs. They're real. What investment options they offer. Make sure they're familiar with real estate if that's where you want to go. If you're looking to invest in something else, make sure they understand that asset class so they don't look at you like, you don't know what you're doing when you say, hey, I want to passively lend to this fix and flipper. Make sure they understand that. And look at their ratings. See what kind of customer service and support they generally offer. That can be very important. You want to make sure that when you find that great investment, that you can jump on it quick while there's space available, right? And then you want to choose the type of account you want to do, right? So there's self-directed IRAs and there's 401ks, and they can be either traditional or Roth. So we're going to delve into these a little bit more, but those are the kinds of things you'll have to choose from. That 401k is only going to be an option to you if you are self-employed or you have a small business where you're the only employee or you and your spouse. If any of those fall into your court, then you could do a 401k. And those are very powerful. So I would highly recommend the 401ks if you're eligible to do that. Then you need to obviously open that account, and then you need to fund the account. So a lot of people miss the opening of the account. They might be looking to fund it by rolling over an existing 401k or IRA. Well, you have to set up that other account first. It doesn't mutate into becoming that. So make sure you set up the account first and then you fund it. So yes, you can either fund it by starting to contribute to it now, right? Or if you already had a previous 401k or self-directed, or not self-directed, but you had a regular 401k or regular IRA, you can roll them over if you own that policy. So if you are currently employed with an employer, and then they probably own the policy, but maybe you had a previous employer prior to that had a 401k plan or an IRA, then you are now the owner of that. Or if you leave your job that you're currently at, you will now own that account. Once you own the account, you can do what you want with it, and you can roll it into a self-directed account. All right. If not, your option is to set up a new account. All right. So let's dive a little bit deeper into these various accounts here. All right, let's talk about the IRA first. So this is an individual retirement account that allows investors to hold a wide variety of alternative investments. We kind of talked about what those are. So you're no longer limited to stocks, bonds, and mutual funds, right? You can do the traditional route, which ultimately we were sold that that was the way to go because all your taxes are deferred, right? That means that you won't pay anything. It's all pre-tax dollars that you put into that account, and then you pay the taxes when you withdraw them at retirement. And they say this will be beneficial because you'll probably be in a lower tax bracket at that time. Well, I don't know about you, but I don't plan on being in a lower tax bracket in the future. I intend to be in a higher one, right? Because I'm investing and I'm doing what I can to increase my income. So that may not hold true for me. The other thing that could hurt you there is the government has a tendency to increase taxes with time, not decrease them. So the tax brackets may shift, and you might end up paying more taxes in the end than too. And also, when you're on a fixed income later in life, is that the time you want to be paying taxes, or is it maybe better to pay them now? So I personally prefer the Roth, but you can do either one. The other thing is if you are investing well in your retirement account and the value of that account goes up. So let's say you put $200,000 of your hard-earned money into this retirement account. You had the option, if you had gone Roth, to pay the taxes on that 200,000. But you put it into a traditional retirement account, tax-free. Now you grow that. You start doubling it every 4 to 6 years. 20 years later, how much is that account now worth, right? Say you doubled it once, that's 400,000, right? Then 800,000, so on and so forth. The point is, you're going to have a lot more value sitting there, and now you're going to be taxed on it. So now you're being taxed on a much greater amount of money. Ooh, ouch. Yeah. So that's why I like Roth, because you pay the taxes up front, you're done with it, you don't have to worry about it in your retirement. And now the wealth inside that account can grow and it will never be taxed. That growth will not be taxed. When you pull it out, it is tax-free money. So for me personally, that's what I like to do. But talk to your CPA about that. Again, I'm not a CPA, but that's something to understand. That's the difference between the Roth and the traditional. Your contribution limits to IRAs is $7,000 a year until you reach the age of 50. After the age of 50, you can actually put $8,000 a year in there. Now, again, if you're rolling stuff and you already have amount in there, that does not count as a contribution limit. That's money you roll. Solo 401k. So if you have that business or you are self-employed, really consider this because you have all the same options as you do with the IRA as far as being traditional or Roth. So you can do both there, right? So the Roth is the tax-free upon withdrawal. The traditional is the tax-deferred, and you pay it on withdrawal. But the contribution limits are much, much higher. So look at this. Right now, $69,000 a year versus the 8,000 there, right? Now, over the age of 50, $76,500 a year. So much higher. And the reason they do that, and so I'm going to explain this, and you can take loans from it, by the way. There's often a loan provision there. But here's why that is, because they allow for contributions to the 401k, both as the employee and as the employer. And since you own the business or you're self-employed, that's you both times. So that's how you end up at this year $69,000 or $76,500. Is you're contributing some as the employer and some as the employee. So there's separate limits for those two, but that's how they get to that that overall amount. All right. We are running a little short on time, so I'm actually going to skip these common mistakes that people sometimes do when they roll those over. But if you're getting the slides, you'll have them there. Also, I'm going to offer you this. This is my ultimate guide to using your retirement account for investing in real estate. Some of you may already have this. I'm also going to put a link right now. I just put a link in the chat where you can download this directly using that link, or you can scan the screen. But if you scan the screen, you will have to put in your email address. The link, you do not have to do that. So if you're on live, take advantage of the link to do that. I also see that there's a question here. Will this be available? Is this recording available? Yes, I will send out the recording. So I will send that out as well. So yep. So hopefully that can help you dive into any of that, because I do want to keep us on time here. So steps to getting started, if this is of interest of you, first of all, you need to set up that retirement account, right? The self-directed retirement account, if you haven't already done that. Then you need to find a capital allocator like myself through Blue Vikings Capital, or you can find a deal sponsor by attending lots of real estate events and getting to know them. So if you'd like to travel, that's a great way to have a business write-off. Go travel to real estate events and then also meet with a lot of people who are doing this, right? Then you need to schedule a discovery call, or it's called qualification call. But this is what I said, you need to show that you have some level of sophistication, or ask that capital allocator what you can do to get that sophistication level, and let them kind of feel out if you are ready for this kind of investment. Maybe you've already done a bunch of investing, so you feel like I'm ready to go on this kind of thing. But those discovery calls, they're not a sales pitch. They cannot offer you, or they should not offer you investment opportunities during that call. It is really just for you to get to know them and for them to get to know you and see where you're at with things and offer you resources and all that kind of stuff. But it's not to push a deal down your throat. There's no sales or anything like that. There's also never a charge for any of those kind of calls. Then you should join the investor clubs that particular person offers. That's how you will find out about whatever deals are coming up. So I generally only offer one per quarter. So my investor club members, they're kind of used to that. It's not a daily thing that there's something available. But when they come out, they often fill up very quickly. So it's good to have done your education and research in advance so you know what you like and what you don't like. I always have sample investments on my website that people can go look at. They can see videos of past deals, so they don't have to feel any kind of pressure to get into something. They can just use it to learn. And so then when they see something, they can know immediately, like, well, that's totally not up my alley, or that's exactly what I'm looking for. So you can jump on it fast. Most of these investor clubs have hundreds, if not thousands, of people in them. And oftentimes when these investments come out, there might be room for, 10 people, 20 people, something like that. So the first people to jump on are the ones that are going to get into it. So it is important to do your research before investments come out and not when they come out, because you don't want to rush into something. That's always a no-no. All right, so let's review what we have learned so far and where we've come and where we're going, right? So we've learned why commercial real estate is generally a good investment opportunity. You've learned how you can use your retirement accounts to invest in those. You've learned what passive investing is and the types of investment opportunities that are available to you. We've looked at a few case studies with some sample returns, and we've gone through the steps to create a self-directed retirement account. Common mistakes we did skip, but you can get it in that book. And we've talked about the steps to get started with your retirement account. So I am going to give you a look at what the investing process looks like if you were to invest with Blue Vikings Capital. So first off, we have that preliminary call, right, where I get to understand what your objectives are, answer your questions, and determine if this kind of investing is even right for you. A lot of people aren't comfortable with passive investing because they like to be in control of everything, and you do have to give up some control here. So it's not for everybody. If you qualify, then you can invest with Blue Vikings Capital. You might need to meet some income requirements. So we talked about being accredited or non-accredited investors, right? So I have deals for both, and I just need to know what bucket you're going to fall into, so I know which deals to send you. Once you're accepted, again, you get to see those options. They usually go out by email. I'll usually put deal alert in the subject line, so you'll know that this is one you need to pay attention to versus other invitations to webinars or something else that you might receive. Then you'll want to review that, and then you can set up a call with me again if you want to, and to see, get your questions answered about that particular deal. Then if you liked all of that, you can make what's called a soft commitment. So this just holds your place to get into that deal. It is not a full commitment until you sign all the legal docs and actually wire in your money. So any time prior to that happening, it's still a soft commitment, but it holds your place in that investment, right? And then if all of that gets done, then congratulations, you are now the owner of an apartment complex or whatever the deal might be, and you now just need to track your investments and take a look at those quarterly reports that come out, and you can see all of that in the investor portal. So that's kind of what the process looks like. Again, if you want a copy of these slides, if you hopped on late and missed the number, this is the number to text. If you want a copy of the slides, just put IRA in the subject line of the text, and those slides will come to you. I'll leave that up for one more second if you haven't gotten it. All right. And if you are interested in joining the investor club, you can scan this and you can join my club. It will prompt you to set up a call with me because, again, we do need to have that call. But if you want to start seeing what kind of opportunities are out there, even if you haven't put together your self-directed account yet, you want to start educating yourself. You might want to get on the list so you can just kind of see what the opportunities look like. And that's kind of it. If you want to connect with me further, this is my link tree. This is my website. Remember, I'm a capital allocator. I work for the investors, not for the deal sponsors. So I'm far less biased than someone who's trying to close their own deal, who's going to tell you that deal is the best thing since sliced bread. I'm vetting investment opportunities for my own money. And my money is the first in every deal. I don't invite anyone to invest with me unless I'm in the deal, right? So I'm not just raising money for other people's deals. And by pooling our money, a lot of times we can negotiate much better returns. The last deal I did, we were able to negotiate returns far above and beyond the top tier of the investors coming into that because we're just bringing a much larger check to the table. And when people invest through my company, they also have that third-party person that's looking out for them. I always negotiate that I get a seat at the asset management table. I get to hear what's going on with the property firsthand, directly from the property managers. I can't make decisions, but I get to sit in on those meetings and stuff. So my services are always free. So use me, use my knowledge, use my experience, and get help to navigate this exciting part of investing. So with that, I will take any questions. So you can just put them in the comments section in the chat, if you will, and I'll be happy to answer those. So let me bring up the comment section here. Thank you all for sticking with me this far. I really appreciate it. I hope some of that was helpful to you. And again, I will be sending out the recordings. I'll send slides to anybody who asked for the slides as well. So please don't hesitate if I wasn't clear. I know it was a lot to cover in a short period of time. So by all means, hit me with any questions you want. So if you are seeing this via Facebook or LinkedIn, you may not be able to have access to the chat. You would need to be in StreamYard for that. Or, if you follow the link through Eventbrite, you should be in the right place. So feel free to use the chat there. If you are in full screen mode, you need to pop out of that to see the chat. So, all right, let's see. Will this be, got some questions in here, but nothing that is, can your investment be done in Canada or in the EU, in Europe? Yes. Yes, you can, but you have to set up an LLC in the United States in order to do that. There may be some ways for Canadians to get around that. There's an agreement between Canada and the US, but I'm not super familiar with how that works. But I know I have a brother in Sweden, for example. If he wanted to invest with me, he would need to set up an LLC here, which is not difficult to do. And there are actually people that specialize in that. So if there was something like that interested you, just reach out to me and I can send you names of a couple companies that can do that for you or help you through that path, or at least give you the information to do it. I don't personally do anything like that, but yeah. Robert asks, how do you make money from this? All right, so two ways. First of all, my money makes more money when I invest with other people. So in most of these syndications, there are tiers. So if you're investing at the minimum level of the investment, so say you're putting 50,000 or 100,000 in, you get in a tier 1. So let's say the returns on the tier 1 is a 6% preferred return. Don't worry if you don't know these terms. But that basically just means you'll get 6% back on your money before there's any equity split. And then the equity split over after that might be like a 60-40, 60% to the passive investors, 40% to general partners. If you are investing at a higher tier, say you're coming in at $250,000, $250,000, they might up that to a 7% preferred return and a 70-30 split. If you're coming in at $1 million, maybe it's an 8% return and an 80-20 split, something like that. So basically, when we all pull our money together into a fund, and I write one check from the fund to this, we're going to get in at that top tier, right? So the last one we did, we brought in $2.75 million. We were able to negotiate returns above their top tier. So we got a 90-10 split. We got I can't remember what the preferred return on that one was, so I don't want to say, but it was probably at least an 8, maybe higher than that. And then we also got a cash kickback at the end when the deal closes. So we get much higher returns, and then we all split that. So we're all making our money gets to work harder. So that's the main thing for me is I get my money to work harder because I'm investing in these. And then the operator will usually pay for my fund to get set up. And sometimes they'll give me a fund management fee or um, acquisition fee at the front end. That's not always guaranteed, but sometimes I get that. And that's can be anywhere from 1 to 2%, something like that. And I'm usually not doing this alone. There are other capital allocators. We all come together to do these deals together. So we have lots of eyes on the deals, lots of people looking at it and that sort of stuff. So that's how that works. Fair question. All right, are those all the questions? I must have done a really good job. Either that or you all fell asleep and that's all there is. So, all right. Oh, here comes another question. Let's see. I have some properties in the EU and I want to develop. I own the land free and clear. Question is, would you be interested in a joint GP, LP, etc.? And a follow-up question, if not, can you help me raise funds for these projects or know someone that would be able to help with that or on a win-win? Thank you again. Okay. All right. So that's a lot of questions. So let's break that down. Lands in the EU, I do not personally invest in the EU, and it's not that I have anything against the EU. As my name implies, Blue Viking Capital, I'm actually from Sweden. I was born and raised in Sweden, and I am an EU citizen, but I don't know much about the real estate market there, and I don't invest anywhere where I don't understand the market. But that doesn't mean that there aren't tons of people out there. I am heavily involved with lots of other capital allocators. So I can float that out there. So send me a email with information about that property, and I will present it to. Actually, I'm going to be in a meeting tomorrow with some capital allocators, so I can talk to them, see if there's anybody there that's in the EU, and have them reach out to you directly on that. Yeah, so I'm not going to raise money for it, obviously, because it's not something I would invest in, and I only invest in things, raise money for things I'm going to personally invest in. So. All right. You're welcome, Robert. Thank you. All right. Well, we are a few minutes after 1 o'clock, so unless I see any other questions in the next minute or so, I'm going to bid you all a very good rest of your day, and thank you so much for joining me. And again, reach out if I can help you with anything at all. I'm here, and I don't cost you anything. So. Okay, Robert says he has one more question, so I will hold for you, Robert. All right, I'm writing down your email, Daniel. Yeah. I'm assuming Robert is busy typing. Oh, here we go. When you talk about a 5-year time frame, for example, does that mean I can totally pull out of that after 5 years? Yes. So if you're talking about 5-year hold, that means there's an exit in 5 years, meaning the property will be sold, and so you'll no longer be an owner. So that's when you get the sale proceeds. There are also some properties that will actually have a refinance at some point. So maybe they're going to hold for 7 years, but maybe they'll refinance in year 4 or 5 to get you your capital back. If that were to happen, you're still an owner, even though you get your money back, but you will no longer get the preferred return part. Generally, that is based on the equity you have in the deal, but you'll still get your equity split in there because you're still an owner. So you still own that same slice of equity that you did all along. But yes, so if it's a 5 year hold, then 5 years they're planning on exiting the deal, meaning planning on selling the deal. Now, something to understand is that um, these are all plans and they're based on the knowledge when they put it together. There are times when a deal sponsor will project a 5 year hold, but then they'll get a remarkable offer in year 4. They might sell early, or in year 5 the market is down and they're thinking, I'm not going to make as much of a return for my investors. If we sell now, we're going to hold till year 6 instead. So the plans are subject to change, so always know that going in, but they're always going to have the, you know, the the owner's best interest in mind when they're making those kinds of decisions, because they are owners, right? So they're looking at it from the same standpoint. So there are always projections when they do this. Okay. Karen has Capital Opportunities Network. Um, so Karen, can you elaborate on what that is? What is Capital Opportunities Network? Are you asking for that, or that's it's in capital letters? So is that an organization that is a network for that? You're welcome, Robert. Have a good rest of your day. You're very welcome. Thank you so much. I love Sweden too. I still go back there very regularly, still have family there. So it's just there visiting my brother not too long ago. So looks like that is the end of the questions here. So thank you once again for joining me, and I wish you a great rest of your day.